Good evening, everyone. We are in a very, very interesting time where there are a lot of uncertainties that are happening around us. Maybe we can call it as a climate change. It could be a pandemic, or as insurers or those people who are really protecting the interest of the economy, as well as the proprietors and the individuals against all these uncertainties. Now, the question is, what are the risks that we are exposed to today? And how are we going to address these issues? Is something which is very, very interesting. And we have some of the experts from the general as well as the life insurance industry with us today to discuss on what exactly is the risk which is there today and how are insurance companies mitigating those risks, not only for the customers, but also for themselves. So I have great privilege in introducing the panel members over here. We have Mr. Vikas Chaudhary, who is the appointed actuary, as well as the Chief Risk Officer of Future Generali Life Insurance Company. Right. We have Mr. Jaspreet Singh. He is the Chief Risk Officer of Reliance. Good evening, Mr. Jaspreet. Nice to be a part of the, have you here. Yeah. We have Mr. Siddharth Kaushik, who is the Chief Risk Officer of Canara HSBC. Good evening, Siddharth. It will be a pleasure to have you on board this evening for this discussion on risk. Mr. Vikas, you have been having a very, very important role of handling the appointed actuary as well as the Chief Risk Officer. So I'll start with you. See, all insurers are interested on improving their top line. Actually, the premiums have to be more, then only the valuation, everything goes up. So naturally, everybody is very keen on increasing the top line. But while we are increasing the top line of premium, we also have something from the regulatory framework which says you need to maintain adequate solvency margins to ensure this premiums are safeguarded. So the regulatory framework, they are doing their job. So how do you see this as a risk? Is it good, or you feel there could be some changes on this?
Thank you, Ravi, for giving me this privilege for such an august gathering. Thank you, my fellow participants. Also, quick disclaimer, any views suggested are of personal opinion, not in capacity with respect to employer, my profession, anybody linked forever, whatsoever form. So that's the first disclaimer. I think it's a fair question. We are into a regulated regime. When you talk about it's extremely regulated across the world, right? So for here, the way we look at solvency, solvency at the end of the day, it is a measure of capital requirements, right? In India, when we talk about life companies or non-life, for that matter, the insurers are currently subjected to Solvency 1 regime. But effectively, a Solvency 1 regime, when we talk about the UK kind of a language about that, a Solvency 1 regime means it's a factor-based capital, which means the higher is the business you will write. If the reserves are higher, you want to keep a factor based on reserves, keep a factor on sum assured or sum at risk is what we call it. When you talk about capital, there are two things you need to look at. How do I protect solvency? Is it a risk? Two things, I'll go a bit mathematical given my background. You look into how do I improve my available capital? How do I reduce my required capital? So that's the way I typically look into. Now, available capital, right business, I need more capital. Pretty easy. I ask shareholders to give me equity, right? That was the scenario a decade, 2 decades before. Capital is a resource which is non-renewable. You can't get it every time. Shareholders have stress. COVID has actually shown that. I think regulator has been quite nice on that, and they did realize this about 5-6 years because 5-6 years before, and they actually had a regulations called other forms of capital. COVID has been the time where people have used other forms of capital, one being sub-debt, which is subordinated debt, which is subordinated against the policyholder's liability. Both life and non-life company have been really thankful to the regulator for such kind of a regulation, which has come extremely helpful during COVID times. If you see, many insurers have come through. However, there are challenges even in this. For example, you can use share capital, you can use sub-debt, but sometimes if you're not listed, if you do not have enough branding, you typically end up taking the sub-debt from your own parent company, which is a proxy to capital. So how do you manage as a management from a capital standpoint of view? You manage available capital, you can manage through P&L. How do you manage your P&L? You write less capital strenuous products, for example, through reserves, or you manage your OPEX. standard answer. I said you look into depreciation, you look into whether I could go in a capex model or an opex model such that I take care of those expenses and so on and so forth, right? But there are other forms when we talk about available capital from a P&L standpoint versus available capital from solvency calculation purposes. In India, there are certain assets which are inadmissible. So you need to really look into how do I improve my inadmissible assets? For example, GST credit. Input credit has been quite a challenge, and I'm again going a bit technical into that, or getting your insurance recoveries. Now, those are another one. One unique thing, Ravi, which has happened, especially for life, is that they have started managing their interest rate risk through derivatives, which is majorly being FRA. If you would have heard every time people talk about life companies, FRA forwarded agreements, because they give guarantees as nominal interest rate guarantees over long term, they map it through bonds and they actually buy it earlier. That's right. Unfortunately, the regulations actually value them at market value. And anything which is marked at market value, the regulator says any upside you cannot take, but any downside you have to allow for the capital calculation purposes. So suppose even if you're not selling, the unrealized losses, you can't take that as a credit, unrealized gain, but unrealized losses, you have to actually book it. That's pretty challenging. So you need to be very, very careful when you enter into such kind of a derivative arrangement. As far as required capital is concerned, there are ways, if you look at, there are capital intensive businesses in life company, and I'll speak a bit about life. There are capital light businesses. For example, protection is a little bit capital intensive. So even though there is a penetration gap and a protection gap, if you would have remembered recently, I looked at it, 83% is the protection gap, not necessarily with respect to people, but with respect to the sum assured they actually have taken. That's the gap. But in that gap, protection also is capital gussing business, more so for group business, group protection business. And also, now those are certain management, there are how do you do, but there are certain challenges from regulatory standpoint. I think we are working towards it, and regulator has been quite warm on this and welcoming on thoughts about how do we manage this capital. Also, there are big inconsistencies, especially for 1 year businesses between life and non-life, and they're trying to control over there, and we are working towards that. So those would be my in summary to manage the risk and mitigate.
Thank you, Mr. Vikas, for the wonderful, clear explanation. We could get a lot of insight into that. So I want to now say that now this has been an unprecedented times. The last 2 years, if you look at, most of the people have been working from home. There have been a lot of lockdowns, etc., etc. And now it has affected the revenue of many of the companies. And naturally, the available funds also has come down. Do you feel this will be affecting the insurance business, or on the contrary, you feel this is an opportunity where actually insurance companies, since they cover uncertainties, this is a time for us to get into and pounce into the market? From a risk perspective, how do you foresee this situation?
Thank you so much, Ravi, for the question. And I would like to thank, first of all, for the opportunity to be a part of this esteemed panel. And again, all my views are based on my personal experience. So pertaining to your question, Ravi, there is always a saying, and I always say these sayings have some meaning to it. Challenges comes with opportunities. And this is the way we look at it. If you look at the data, all the major, I would say majority of the insurance companies have grown in the last 2.5 years during the pandemic period. So while yes, there has been issues in terms of the economy, there have been issues in terms of lockdowns and all. However, I guess this was an opportunity which everyone has utilized to the, I would say, in the right manner, because there was an enhanced awareness amongst people also, wherein they could understand that, yes, this is an opportunity time and it's very, very important for something like a life. And I'll not say even life insurance, even the general insurance when it comes to the health. So that enhanced awareness definitely helped everyone. The most important thing would be to go ahead and continue with the momentum. But yes, with this comes certain associated risks. And I always say risks are constant. It's the residual risk which increases or decreases basis the environment, basis various activities. So certain things like when there was a remote working, people were selling, they were not able to go ahead and meet the customer face to face. But then as a risk management function, we need to be vigilant and we need to be dynamic enough to go ahead and suggest controls which can minimize the risk and at the same time provide that enablement to the business. Yes, there are opportunities. We need to go ahead and I would say use those opportunities to the fullest, but at the same time, we need to be vigilant enough in going ahead and having requisite frameworks, which ensures that whatever we do remains within the appetite of the organization, remains within the appetite of the regulatory ambit.
Thanks, Siddharth. That's wonderful. Looking at a risk as an opportunity as well as a threat. Just one single question on this. Have you revised the risk registers? Because this is a global phenomenon that happen only in India across. As a risk manager, do you feel the risk registers have been revised due to the pandemic?
Absolutely. I guess if the risk, I'll not call it the risk registers, but I'll call it the risk profile of the organization. There have been certain risks which have definitely, I would say, increased given the residual nature, and there are certain risks which are also the inherent nature. I'll say like information security. We were discussing offline some time back. While there have not been incidents many in the insurance space, but does that mean that we can just go ahead and relax? No, definitely not. I would say, sophistication of the threat vectors of this particular risk increases, and I would say brings to attention the fact that we as a life insurance or insurers need to go ahead and enhance and spruce up the controls and deploy the controls in the right manner with adequate monitoring. So this is just one example of information security. It comes along with other things also, as we were talking about the interest rate. We have seen the interest rates moving, I would say, big time in the last 2 years. Now, slowly and steadily, there is some, I would say, at least stability out there. But yes, so risk profiles have changed. The profitability, we saw tremendous increase in the number of claims from a life insurance space. So when you look at the profit numbers of various life insurers, that have changed. So yes, there are these factors which change the risk profile, and we need to be dynamic enough to go ahead and change the profile, look at what are the customized measures we can take from a short-term, medium-term, and a long-term perspective.
Oh, great. Thank you so much, Siddharth, for the clarity. Now I move on to Jasmeet. I think Sundar has also joined. Jasmeet, one question for you. See, now this working from home, etc., is one area where people started. Almost everybody, whether he's a claims guy or an operations guy, especially in the GI space, almost most of the people are working from home. But the service parameters have not been affected because every company has taken their own methods of how to run as organization very safe so that the customer doesn't suffer. Right. But according to you, has it increased your risk profile of your organization because everybody is working from home and everybody is using Wi-Fi? There could be different hijackers who can get into the systems, do it. Number two, as the business grows, we have given applications to all customers, intermediaries, everybody applications. So everybody is using your company system to enter into. How, as a risk manager, you are being able to address these issues?
Okay, great. I think, Ravi, this is a very, very valid point which we've been debating and discussing. And apparently, this comes to everybody's mind that, when we are migrating to work from home, what happens, and I'm sure there has been a great transformation which has happened in the last 10 odd years, I would say, where, eventually technology has taken a very, very strong hold in the insurance industry. And, in last few years, we must have even observed that there are various organizations, which have just come as startups, but they are focusing primarily on technology. So their bread and butter, selling, everything happens on technology. And today, mind you, if any organization, be it a seasoned organization or a new organization, if they have to exist, technology is the key. But nevertheless, I think with technology, there are large number of responsibilities which kind of come on as a risk perspective. So today, we were, say, on a very on-prem kind of an approach. Now we are trying to kind of, look at an hybrid approach where you're moving on cloud. You're trying to kind of, outsource a few of the things which you were kind of keeping with yourself. So earlier you thought that I can do the entire A to Z of the bit. Now, today you believe that, okay, let me do A to D, which is my expertise, hand over the next two parts to an expert who can probably do better than what I can. So, that's how this hybrid approach of cloud and your on-prem kind of a structure has really built in a lot of flexibility and also cost optimization. Because eventually, if you actually see otherwise, an on-prem kind of a cost is pretty high as compared to a kind of cloud structure. While I don't say that only a cloud structure is a great structure or an on-prem structure is a great structure, but depending on the nature of the application, depending on the nature of database, depending on nature of how you want to restructure or structure yourself, it would make a larger sense for you to take an approach which is in the best interest of your organization. So I think that is very, very critical from a risk perspective when people were moving on work from home, while fortunately, we always had anywhere processing kind of an approach within our organization, which is, we've been practicing since 2010.
Fantastic points. Thank you for the input, sir. Now, we have Mr. Sundar Natarajan from India First, who is the Chief Risk Officer. Good evening, Mr. Sundar. Nice to have you over here. So the question to you, now, everywhere in the corporate governance, we are talking about risk management is now moved to the next level, which is the enterprise risk management. Now, the corporate governance, when you go to the board meetings and then you produce this thing, people are asking only about enterprise risk management. How do you see insurance companies have adapted themselves to the new enterprise risk management?
Good evening, Ravi, and thank you very much for inviting me on this panel. Delighted to meet Siddharth and Vikash.
Hey, Sundar.
And very, very interesting question, something very close to my heart. And I'm sure it's close to my heart of my co-panelists as well, being CROs of their respective esteemed organizations. Enterprise risk management was a jargon, okay, and it is not one anymore. I would say it is on course to becoming reality. And if you were to use just the simple dictionary meaning of the three words, enterprise and risk management, enterprise, risk and management, it is only that, okay, practicing risk management across the enterprise, as simple as that, in an attempt to overcome jargons. So it's like this, the typical perception of risk. If you were to open your family WhatsApp group now, just as we speak, and ask a question, is risk good? Okay, the typical answer will be question mark or nahi or bad. And if you were to ask another follow-up question, what is risk? Describe an activity. The answer typically would be a poker game or a horse race or a roll of dice. And that's the perception of risk which has been built over time and which has always been pejorative. Risk is, and that feeling and that perception has fed into the boardroom and it has fed into organizations. Okay, so risk management by virtue of that, risk management has also got viewed with that lens. Risk management, as some of my colleagues said, if we have to look at risk as an opportunity, and if we have to, which it is, if you don't take risk, you will not get a return. If the farmer doesn't go out in the fields at 4 o'clock in the morning, every day on day for 365 days, there is no harvest festival of Pongal and Lodi which can be celebrated in the middle of January. And you and I won't be eating food. And he will not get, he or she will not get any which they can have. There is a risk management committee and there will be a few top risks which will get discussed in that risk management committee. There would be good discussions. There would be good initiatives and risk mitigation measures talked about. But these would get relegated to the very, very top few 4 or 5. And, and then it would stop over there. If the risk and the outcome were to make or mar the business, then it would get acted upon. Else it will get sidelined. If we really need to look at ERM and implement ERM, it can make a world of a difference to an organization. If every single function has a risk expert, as we call it at India First, and that person practices risk management. And by practicing risk management, one need not do something dramatic. You don't need to go and write a thesis. All you need to do is keep it basic, stick to fundamentals, ensure that there are well-documented processes, ensure that those processes are followed, ensure that the function looks at exceptions to the processes on with regularity, and the function takes ownership for the exceptions. And these can give us bottom-up risks. Okay, these are the funnel which can give us bottom-up risks. We've started experiencing that already. And these bottom-up risks combined with top-down risks which flow from the senior leadership or the board make up the risk repository of the company. You are absolutely right. The earlier question which you asked has, with respect to the risk register and COVID times, absolutely, we've seen that COVID times have found new kinds of small risks which come up bottom up, which never would have got envisaged top down. These today may not be making a big impact today, but may make a big impact maybe tomorrow.
Thank you, Sundar, for the clarity and very well explained about the enterprise risk planning. Thank you so much.
So how do I perceive, and I just wanted to share my thoughts from a risk standpoint. I am looking from a risk which was 8 years back when I took over as CRO, but effectively an actuary. And what I looked at is how important this department is. What are the key points? So what I looked at is when organizations mature, companies like life insurance, which is always big, it doesn't matter from a size standpoint. It is a regulated entity, it does require many number of people. What happens from that is that people work in silos and the risks are compartmentalized. And that's my way when I looked into it. The risk department actually cut across all the departments and provide a singular view across all pictures. And I'll give you an example to this. And I try to look into complaints, for example. Now, complaints is a silo department sitting in operations. But if you start analyzing complaints and the NPS score, you actually realize there are problems in your process. There are problems in your selling process. To an extent, there are problems actually in your project of recruiting people because you're not actually recruiting the right people. And you start deep dive into each of these areas that there are challenges in your own processes when it comes to service complaints. There are challenges in your customer journey, which is a problem of sales process, challenge and attrition. Then the recent example when you saw in 2018 was this ILFS scenario. And of course, it was new to me. It was people were exposed. And we realized that do we really have a risk appetite framework? So we had on paper, but when you really deep dive a clear risk appetite framework with respect to credit risk, with respect to investment risk, and more so these days about how much is your risk appetite to even retain the risk vis-a-vis how much you want to cede it to reinsurer. Now, do you have an organization-wise complete risk appetite framework? So, and actually can suggest again about this is the retention I should do. A CIO can say, oh, it's a good time I should invest in corporate bonds and so on and so forth. They give 60, 70 best delta or equities, it's good time. But as an overall, have we tried to do a lot of stress tests? And that's where these CROs play a very important role from a mathematical standpoint to provide stress tests. And the last one I see is the role of CRO in the strategic planning of the organization. When companies prepare a plan of 3, 4, 5 years, and they have some targets, does enough stress has been done to do a lot of sensitivity and scenario analysis to show that if things go wrong, everything cannot be rosy, and these are your challenges and you need to act. So that's my two best when I look into from an enterprise.
I agree, and a very well touched point, Vikash and Sundar, thanks. One of the most important things, and again, being there in the risk throughout maybe my career, the most important thing from an ERM perspective, and now that we are seeing in more and more matured organizations, is the intertwining between the risk management function and the strategic discussions as well as decision making. Till the time risk managers or the risk management team is not completely aligned during those discussions and decision making, never ever will a company be able to have a successful ERM structure in place. So I guess that's one of the most important prerequisites for any ERM structure to be successful, that the risk management team and the risk managers have to be a part of those strategic discussions as well as decision making. It can be backed by mathematical calculations. It can be backed by experience. So there are multiple facets to it, but yeah, that's one of the core to success.
Thank you, Siddharth. Now I move to Mr. Jaspreet. See, this is something which has been always been coming to my mind. See, till this Suez Canal episode happened, people have been talking about the loss of profit policies, etc., etc. But then this climate change is a new risk that has evolved across the globe. And most of the companies, even globally, are looking at climate risk as one of the very, very serious risks. Now, from an insurance company point of view as well, now, how do we foresee these climate risks in our books? And what are the new innovative covers that we can provide to our customers, taking from a risk to an opportunity? Yes, Jasmeet, I'd like to hear from you.
Yeah, yeah. So I think great, very interesting point. So I think, for typically all the industries today, not just, I would say, insurance, I think climate change to humanity becomes a very, very important aspect and point to kind of, maneuver on, understand, and really kind of, work towards it. So just to give you a small kind of, a figure, which I'm sure will give you a very different perspective. I was just referring a McKinsey research report, which typically says that, there's an increase from about 2% of global GDP to more than 4% of global GDP in 2050, which will be induced to these climate hazards. So this is the kind of impact which we are kind of, looking at and talking at, which can actually wipe out various things which one can even, right now not even think of. Simple examples to give you, maybe, which comes to my mind is like earlier cyclones used to be, a primarily focused agenda on the eastern coasts. But then, in the last few years, we've seen that the entire belt has kind of migrated towards the western coast as well. And the way we have industries around the western coast, I think the exposures are way, way, very high. So I think, this is very, very critical for insurers to kind of, not just talk about it, but even kind of deeply understand, maybe today there are concepts like stress test, where you do a total exposure against projective climate hazards. So what is it? I mean, to understand the risk exposure to climate change, all insurers today are adopting climate specific stress testing beyond traditional CAT models, so the catastrophic models, to understand the impact of climate related risk on their portfolios. So I think these kind of steps which are being taken further, I think as you asked that, what insurance companies should do. So I think the biggest thing which one needs to do is liaison with the regulators, the government, because I think these initiatives cannot be done in silos. This is a very, very large kind of initiative which needs to be kind of derived and worked upon. Otherwise, one small step taken obviously adds value, but it has to be, various steps together. So simple things which I can tell you, help organizations mitigate their climate risk. So what we've started doing is we've started engaging with our customers and started giving them risk management, facilities, which we kind of tell them that how you can prevent a physical climate risk, what kind of, shifting business models you can do, say from a transactional risk transfer to a indemnity payment or towards scaling existing incentives. We give rebates for using resilient construction material, so such kind of things really help, even the customer kind of build structures which are strong enough and, can be a little difficult, kind of prone to earthquakes and so on. You can together build that culture. And, government can create that kind of mandate that in low-lying areas, you will not allow this kind of a construction, you will put restrictions. And it has to be a global phenomena altogether. So it cannot be worked in silos. I think that's something which is very, very critical and should be really not just discussed, but implemented.
Wonderful, Jasmeet. That's a wonderful. It's not only educating the insurance companies, but also the customers who are actually going to suffer. That's a fantastic point. Now, I come to Sundar. One question I'd like to ask. You see, as risk officers, probably we are also doing a lot of fraud analytics. So what we do is sometimes we do it internally. Sometimes there are companies which are exclusively doing fraud analytics. See, most of the companies in the international market, they outsource the activities to India. So similarly, such a situation could happen in India as well, wherein we may not like to do it for nature of confidentiality. We would like to outsource this fraud analytics to an external agency, a third party. Do you feel that's a risky thing, or you feel that's one risk mitigation measure, Sundar?
Okay, thank you, Ravi. Very interesting question. I think the first time if I recollect right, I heard the word analytics. It was about in 2010, and I helped implement an analytics model for persistency in the organization. And my first impression was very bad. I thought that it was glorified Excel. and the analytics, and it was a firm a consulting firm which helped implement it. I thought that we knew far better than the consultant. But the trick is this, anybody who's a good analytics expert and is only a good analytics expert may not necessarily be effective. Okay, so that applies to fraud analytics as well. So it has to be a convergence of knowledge of fraud and anti-fraud management and analytics, which will kind of help us find the light. Can we outsource it? Yes, of course we can outsource it. There's no challenge as long as we have good legal protocol and data protocol followed, which I think we can. The larger thing is, will it be effective? The effectiveness quotient will go up only if the organization is fully entrenched and involved in developing it. And from that point of view, if you ask opinion, I would not like to outsource it. I would like to develop it, customize it to my own, and take inputs from expert organizations, take inputs from organizations which provide distributed ledger services, like your IIB or like any of the credit bureaus. So to answer that very specific question, it can be, but I would prefer not to. Having said that, what I would say is fraud analytics also should not get restricted to a very matchbox view. Fraud analytics has to be looked at from not even purchase to servicing. I would say even prospecting. Before prospecting a customer, what is the target customer base? Okay, what kind of are we talked about climatic risk, and we talked about areas susceptible to climatic risk. Okay, there are areas susceptible to fraud risk. Okay, so segments which are susceptible to fraud risk, do we want to sell in those segments? It starts right from there, and then how do we do a pre-sale? How do we conduct the sale? How do we evade challenges of AML? How do we evade challenges of impersonation? How do we evade challenges of digital risks which come by today? How do we evade challenges of overcoming phishing attacks in digital transactions? How do we evade challenges of customer impersonating during the servicing stage? Okay, and how do we evade risks where it matters the most, claims-related risk? How do we evade policies which get sold after somebody has died? So it is across the, not only I would say the policy life cycle, but from the time you envisage the strategy to sell right up to claims or right up to maturity. We need to look at fraud analytics at every level. And there are propensity models which can be applied at every stage and integrated within the function. And the charm is if it can be actually owned by the function rather than by the analytics team. So similar to what I mentioned in ERM, analytics has to get owned by the function, and they have to actually use it. Else it will become an ivory tower. The analytics team will show it in their PPT and win awards, and we won't get any benefits.
Okay, thanks for your inputs, Sundar. So Siddharth, my question before we wind up the session. See, there have been a lot of telecallers who have been calling people and then saying that, see, your life policy, you have to pay one more small amount so that you will get a lump amount. This is something which normally is something that's almost, whether it's X company, Y company, a lot of telecallers who are doing this. How is the life insurance company, we are addressing all these issues?
So see, for that, I would say I'll break it into two parts. For this particular issue, one is a very, very proactive customer communication. And when I say a customer communication, it's not only, I would say, segmented to your customers. It has to be more widely communicated. So you can use mediums, social media as a platform in going ahead and educating the customers. But yes, that's having a limited reach because not everyone will be going ahead and visiting. What more important would be, what are the controls you are putting at the back end? Because as Sundar rightly mentioned, that there are segments wherein he would not want to sell. I would say it even starts from this perspective. Are there people you would want to be there in your organization? Do you have models going ahead and looking at the human resource capital and getting them onboarded? So it starts from that perspective, from that very point to a point that, okay, if there is an insurance sale, how as a company you are ensuring that the sale has been done right? So you need to have checks and balances at the back end. Majority of the companies that now I'm seeing have a concept called as a validation call or a welcome call. And now technology is being also used wherein video validation callings are being used. So all these things are being done up. But yeah, the most important thing is, as I said, with the strategic alignment, are you doing it on 100% of your base, or are you doing it on, let's say, a 30 or a 40% on the base? That depends on the risk appetite of a particular organization. Majority of the companies are now moving to a video-based validation calling, covering maximum of the base. The regulator has been proactive. So there are some regulatory asks wherein we have to share the policy document with the customer. We have to share a key information document which highlights the key things. So all these things are there in place. But one thing that I would want to say is how effectively you are doing it. So just doing, and I'll just pick up an example of a validation calling. Are you going ahead and doing it as a tick box exercise, or are you doing it with the genuine intention of making the customer aware of those things? One is a telecaller calling up, selling a policy, then another telecaller calling up and just narrating the entire story. You have this policy, you have this, you have this, you have this. It loses interest. How you are engaging the customers? Are you just telling him, or are you asking him that, okay, are you aware of this? Are you aware of this? So that's where I would say the real risk management, and as CROs, I would say it's very important for us to look at these processes at the grassroots level, how they are getting implemented. And I'm sure with all these new technological investments, they are really helping us out in going ahead and making customers aware before issuance of the policy as well as post issuance of the policy. And then there is a new concept known as engagement calling. So people are going ahead. So generally in insurance, what used to happen that you sell a policy, there is a touch with the customer, then there is a renewal, there is a touch. Are you engaging with the customer during the tenure of the policy? So that those are a couple of things that I'm seeing majority of the insurers are coming up with, and I guess we are moving in the right direction.
Thank you, Siddharth. So I would like to thank all the panelists, Mr. Jasmeet, Mr. Bikash, because Sundar and Mr. Siddharth for your sparing your time and sharing your thoughts on the RiskNext. Thank you so much.
Thank you.
Thank you so much,
Thank
Ravi.
you.
Thank you so much to my panelists.